Good morning. It's Friday, the 28th of November, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital, our top stories and themes. And by the way, we are still smogged out. The Sensex and Nifty hit record highs even as they rise in a narrow rally. The Reserve Bank of India sells $30 billion to stem a slide in the rupee. The Nifty's record calm defies the rupee's run as Asia's worst currency. Oil slides to $63 on Ukraine's ceasefire hopes, and that obviously helps India's margins, the India Energy Week segment. Mahindra challenges Tata's EV dominance with a new $22,000 SUV. KKR sees a $7 trillion AI boom as an industrial revolution and not a bubble. And Sam Altman's allies face a reality check as Google's Gemini 3 gains ground.
This is the Core Report with Govindraj Ethiraj.
The calm versus the ruffled. When we started out in the year, the rupee was the calm one and steady for that matter, and the indices were volatile. It now appears that it's almost like the other way around. The currency has not been calm for sure, and the indices have been so. More on that in a moment. It was a big day for the stock markets with the Sensex and Nifty finally hitting those record highs, though that was intraday, and then they returned to close at slightly lower levels. But even those records conceal a lot, and we will come to that. At close, the Sensex was up 110 points to 85,720, and the Nifty was up 10 points to close at 26,215. But during the day, the Sensex hit a record high of 86,055, and the Nifty hit a record high of 26,310. The last peaks were in September 2024. The Nifty Midcap 100 and the Nifty Small Cap 100 were slightly flat and also down. That's the Small Cap 100 was down about 0.5%. More on the story behind the story in a moment, but broadly, this is a very narrow market rise. And to talk about that, we will be joined by Devina Mehra, First Global shortly. And the picture, of course, is grim. Almost half of Nifty 50 stocks haven't even touched their all-time highs, which means only a few large-cap heavyweights have driven most of the gains. A report in the Economic Times says that trend shares have fallen 40% year-to-date and would have to double now just to reclaim their October 2024 peak. TCS is down 23%. Wipro, Tech Mahindra, Power Grid, Infosys, IndusInd Bank, HCL Tech, Dr. Reddy's are all stuck in double-digit losses for 2025, even as the Sensex and Nifty have risen 10% this calendar year. In all, that report says 23 Nifty stocks are languishing at least 10% below their all-time highs. The BSE Small Cap Index is also down 5% in 2025, unable to recover its losses, and the Mid Cap Index is barely 2% higher. And then, of course, there's that giant sucking sound being initial public offers and offer for sales, which are draining away investor funds, mostly to provide exits for institutional investors, domestic and foreign, apart from founders and promoters, and not much money going into companies themselves, which could, of course, be used for economic expansion and growth. The rupee itself was not much changed on Thursday and closed at 89 rupees 30 paise against the dollar, down marginally from its close at 89 rupees 27 paise in the previous session, according to reports from Reuters. The rupee has, of course, stabilized after touching a record low of 89 rupees 49 paise last week, though analysts say depreciation risks remain amidst weak trade and portfolio flows and uncertainty around US-India trade talks. Yes, so while the indices did hit those much-awaited record highs, uncertainty on the US-India trade agreement still remains, and we are, of course, still expecting that something will happen in a few weeks' time. Meanwhile, the International Monetary Fund has reclassified India's exchange rate regime after the rupee moved more freely and said the nation is well positioned to allow greater flexibility in its currency. The IMF labeled India's de facto currency regime as crawl-like arrangement, marking a change from the previous stabilized classification, it said in its annual country report for India released on Wednesday. Now, that classification of stabilized was to hint that the rupee was being managed, and that did not go down too well in some quarters. Elsewhere, gold prices were steady on Thursday, holding near a two-week high as investors looked once again at the possibility of a US interest rate cut in December. Spot gold was holding at about $4,165 per ounce. Now, the contrast between the rupee and the markets. The rupee is currently Asia's worst performing currency of 2025, also on track for its largest annual decline since 2022. And that was the year Russia invaded Ukraine and oil prices went past $100 a barrel. Second, the Reserve Bank of India has sold more than $30 billion of foreign currency assets since the end of July, according to Bloomberg Economics estimates, and of course, managed to avert a new low in mid-October. At its strongest in early May, the currency was at about 83 rupees 75 paise against the dollar. And then, of course, things turned in July after the US and President Donald Trump imposed higher than anticipated tariffs for a variety of reasons, including purchasing Russian energy and weapons. After that, the rupee has kept falling. Now, let's look at the Nifty. Prior to Wednesday's surge, the index had logged a 77-day streak of intraday moves smaller than 1.2%, a first according to Bloomberg Intelligence. It's also gone 132 sessions without a single day swing beyond 1.5%. And what does that mean? It means that this is one of the world's steadiest gauges, according to Bloomberg strategists. And the 3-month realized volatility sits at 7.4, well below the Standard & Poor's 500's 12.7. So back to the markets, having hit their all-time highs on Thursdays, what do they tell us? That is, the indices tell us, and what do they conceal? I spoke with Devina Mehra of First Global and asked her in a wide-ranging conversation around equities that will play out over the weekend about what she was taking away from the journey so far on the day that the market saw their all-time highs.
One thing which they will not tell you is that I think for most of your viewers or listeners, their portfolio would not be touching all-time highs, because this has been an extremely narrow market. Especially up to August, it was very, very narrow. At that time, only about 10-12% of the stocks were outperforming the index. And I think something like 35% were down more than 50%. So, I mean, in a normal market, you would expect about 40% plus of the stocks to outperform. When it becomes 20-25%, we say it's a narrow market. So to have it as narrow as 10% is extremely narrow. It's broadened a bit from there. But I think still only about half the stocks are down more than 20-25% from their all-time highs. So I'm sure, the euphoria may not be as widespread as the indices show. The other thing to remember is that sentiment is a contraindicator. And this is not something I'm saying. This has come out of research studies in whichever country the research study has been done, whether India, US, Portugal, Brazil, that when there is excess buoyancy in the markets, euphoria, I mean, like if I go back, let's say 15, 17 months, not just the retail investors, I'm talking ultra HNIs, family offices were coming to me and saying, I don't have unrealistic expectations. I'll be happy with 30% compounding. I said, that is an unrealistic expectation. But I mean, last year it appeared the money was there for the taking. I mean, people told me that, why do you say risk management first? Why do you say conservative management? We want to take high risk and get high returns. And only thing certain with high risk is high risk of losses. Nobody is guaranteeing high return. But the flip side to that is that when you are asking yourself, should I get out of the market? Should I stop my SIP? Is exactly when you should be invested, because the next period returns are above normal. I mean, that's the other side of the equation. And right now, if you look at the indices, there's no point looking at even at a crude PE level, looking at the index PE, because the composition of the index has changed so much. I mean, you and I have been around long enough to remember a time when there were no banks in the Sensex and Nifty. And now that's the highest weight. At one point, these indices were full of PSUs, and then there came a time people forgot that PSUs were listed. So these are all cycles. But if you look at the sectoral PEs, these are not at extremes. In many sectors, they are actually below even the last decade's average. And these are not on particularly great earnings. I see a uptick in earnings coming. So between that and the fact that PEs are anyway not so stretched, I don't see grave danger in the market. So everybody understands the danger of being invested in the market, the risk of being rather invested in the market, but there's also a risk to not being invested. And we had done this data. So like from the time Sensex started, which is 40 odd years, said, what if you missed out on the 10 best days? Now it seems like in 40 years, 10 days shouldn't matter. But actually 2/3 of your returns go. So instead of that 100 rupee becoming, let us say, 85,000, you're now at 27, 28,000. If you miss out on the 30 best days, which is not even an average of one day a year, you miss out on 90% of the returns. So most of the time, unless you can foresee a really big crash, it pays to remain invested. But the other side of that is that you cannot buy and forget. So don't think that I bought this stock last year at 100, now it is 65. I will wait till it is 100. It will never come back to 100. It may not come back to 100. The market has absolutely zero interest at the price at which you bought. So you have to look at what is a good place to be invested today. Don't have loyalty and love towards your stocks.
Right. So you talked about narrow markets, which means there are a lot of stocks that have now fallen by the wayside or fallen back. Why has that happened? And if you were to illustrate now with some examples, maybe that are sort of you've been following.
So, if you look at last year, a lot of that euphoria was in small caps and micro caps. And even now, the P's are quite high for that cohort. Not in hindsight, but at that time, I had said, look at the history of small caps. The small cap index fell nearly 80% in 2008, 78% to be exact. It took 8 years before it came to that level, but that's also theoretical because the index churns more than 20% every year. So 8 years later, it is a completely different index. And that's a characteristic of the euphoria in small caps in any cycle, that the stocks that do well in one cycle are not the same ones that come back. It's a whole different list. In fact, even now I was looking at I haven't quite collated the numbers, but I looked at it that all the stocks that have gone from mid cap to large cap, small cap to mid cap, and the other way around. And always the number of stocks falling down from large cap to mid cap and mid cap to small cap is more than the number of stocks that go up the list.
But that's something which I'm sure most people don't look at or notice.
Yeah. And after I was at 2016. So 17, 18, again, there was this mad bull market in small caps. And again, there was a 2/3 fall. So last year, many of these small cap managers who were saying we've given 50% compounding for 3 years, I said, don't forget your school maths. When you come down 80% and then you compound 50% for 3 years, you are still down more than 30%. So that's the nature of the beast. Always remember, again, you will remember this, that how many IPOs came in the 90s. There were 2 years when there were more than 1,000 IPOs each. And today, only about 4,500 stocks trade actively. And the number of listings on the Indian markets is, I think, more than 3 times that, if not even higher. So that means, more than 2/3 of the stocks ever listed are not even trading. They have essentially gone to zero. That is the flip side of all those who tell you buy and forget or long-term investing. That's, you remember the successes, you forget about the failures.
Right. And if I were to go deeper into that, the small cap phenomenon that you talked about, so would that be sector driven as well? Were there some categories or types of companies or sectors which suffered or saw more damage than others?
Yeah, there would be. And there are always these themes that sort of catch the fancy and then need not even be only small cap. So I always say
it could be across the board.
Yeah, I say the easiest rule of thumb to see where there is excess and excessive froth in the market is to see where the NFOs are coming. Whenever there is a cluster of NFOs on a particular theme, and this I'm not talking just 2 years, we've collated the data for 25, 30 years. It is a pattern that when there is a cluster of thematic funds being launched, it is almost always close to the peak of that theme. Whether you go back to the early 2000s, the pharma fund, the IT funds, and whether it was, defense, PSU, small caps more recently, it always comes at the peak of the cycle because it's easy to raise money then. By that time, every person on the street knows about it. There's this FOMO feeling, my friends made this money in this theme and I didn't, so let me get in. So that always happens.
And what would have sustained? I'm trying to single out sectors again. So you mentioned defense, maybe flavor of the month season, and it's maybe gone now. Maybe consumer tech is a flavor currently. We don't know right now. IPOs are mixed. So what are the sectors or themes that have sustained through this period?
So, I can tell you how we were positioned in our PMS. So, since last year, we have been overweight pharma, healthcare, and auto components. We've added a little bit of autos. This year, through 2025, slowly, our systems have started liking FMCG more and more. So, we are now overweight FMCG. We're not overweight banks, but we hold more banks than we used to, especially PSU banks. I'm always a very nervous investor in banks. So people tell me, that's your takiya kalam that you say. That lending is a very risky business. So I'm always
But you've chosen PSU banks over private.
We do have private banks also, As I said, we are not overweight. Also, remember banking as a sector, if you look at last 5 years prior to 2025, it underperformed in 4 out of the 5 years, 2020, 21, 23, 24. So other than 22, it did not outperform in a year. So sort of, it is also a cyclical thing. And it is the highest weight in the benchmark, so I can't ignore it completely. Then we've added very lately has been some of the OMCs, basically in the energy sector. So, I mean, we're not overweight, but that's the thing. And IT, we would be slightly overweight, nothing very spectacularly overweight. But what a system forces us to do is to look at things on both sides, unloved sectors. I'll give you an example like capital goods, industrial machinery. Our systems liked it in October 21 and we went overweight. Most other funds and investors discovered it 2.5 years later when the stocks had already gone up 2-3 times. And the reason nobody looked at it before that was for a good 12 years prior to that, it was absolute dog sector. From 2009 to 21, it compounded some 2%. So everybody said, we won't look at it. So that's why we use what we call a human plus machine system. So
I was going to ask you about that.
Yeah. So the artificial intelligence machine learning system, it kind of forces you to look at the data and not be married to the stories in your head.
So it's a quant approach to investing.
Yeah, it is not a black box quant approach. That's why we say human plus machine, but it does the first filter. And my pinup, Daniel Kahneman, says that a system will always outperform a human being in any game of judgment. If you can, even if it is a relatively simplified system, the very fact that it acts without bias, it acts without noise, the randomness that human beings bring in, it will do a better job. Besides the fact that, of course, it can look at many more companies, many more factors within a company and apply it on the same basis. I mean, globally, for example, we look at over 20,000 stocks. Even if I have 1,000 analysts, they're not going to look at everything in the same fashion. That's the part that only a system can do.
And I'm going to come to global in a moment. But tell me about an instance where, let's say, your emotion was superseded by your machine.
So as I said that, maybe you would not have looked at industrial machinery, capital goods, because it had been such a dog sector. But in systems, this is something called a broken leg analogy, that the system will be better at predicting whether someone will go for a concert. So you should overrule only if you know for certain that person has broken their leg and won't go. So that's the whole point, that, I mean, we do apply a filter after that. Sometimes we will not go by what the system is saying because not everything is captured by past data, but there has to be a good reason for that. So for example, I'll give you in 2020, there was this whole thing of that you can't go wrong buying consumer brands which make a lot of cash. And I actually did a half-an-hour program on CNBC where I broke it down saying that these companies have underperformed for long periods in the past. But the point is that at the time that FMCG was the flavor of the season, nobody was looking at ITC because that was not performing. So for our systems, early 2021, suddenly ITC became very high up on the charts and we saw no reason to overrule it. So next 2-3 years, it was among our top 5 performer. So that's the sort of thing it forces you to do.
I remember interviewing Aswath Damodaran in peak COVID on a virtual conversation, and he was sitting in New York. And where I asked him after everything, I said, what's your favorite stock? And he said ITC. And it was obviously in the boondocks at that time. And then it must have, maybe you invested jointly at the same time.
Yeah, so the early 21, as I said. So that's what it forces you to do, because human beings are creatures of the story. We are very much married to the stories in our head. And without a system, you don't get over it. So that's the whole point.
A strong quarter for oil refiners, the India Energy Week segment. Even as the Nifty hits a new peak, analysts at Antique told Reuters they expect oil marketing companies to deliver another strong performance this quarter, with refining gains and sharp reversal in cooking gas losses boosting profit margins. As long as crude stays in the $60 to $65 per barrel range and retail prices of gasoline and diesel remain unchanged, these firms should enjoy elevated profits, whether refining or fuel retailing drives the gains, they said. Antique is bullish on the sector and has named at least one company, that's Hindustan Petroleum, as its top pick. Now, oil prices were down again on Thursday on expectations of a Russia-Ukraine ceasefire, which could lead to the unwinding of Western sanctions against Russian supply. Reuters reported Brent crude futures at around $63.01. That's $63 broadly a barrel on Thursday morning. And this segment was supported by India Energy Week 2026 to be held from January 27th to January 30th, 2026 in Goa. You can register for the same using the link in the show notes. More electric action. Mahindra & Mahindra has launched a 7-seater electric SUV on Thursday with a starting price of about 20 lakh rupees or $22,000 as it tries to take on a segment that's dominated by Tata Motors. Electric vehicle car sales have been slow and perhaps steady. Sales of battery-powered cars have risen to more than 100,000 so far this year from about 23,000 units sold last year. Mahindra will invest another 2,000 crore rupees on the new car, that's XEV 9S, and a new edition of BE6. These are all electric models as part of a planned investment of about 16,000 crore rupees to develop electric origin SUVs through fiscal 2027, according to a report in Reuters. Electric origin models are designed from the ground up and not adapted from petrol cars, which has been the case in several other brands as well. Mahindra's automotive division CEO said that with the XEV 9S, we are not just playing in the EV segment, we're expanding it. Bookings open on January 14th and deliveries start on the 23rd. And before we continue, join us for the third edition of our partners Algorand India Summit on December 6th and 7th, 2025 at ITC Gardenia Hotel, Bangalore. Registration link in the show notes, and let's get back to the show. KKR investments into AI. Investment firm KKR, which manages about $700 billion of assets globally, has said that the unprecedented surge in data center construction is the backbone of the next industrial revolution rather than the speculative bubble reminiscent of the dot-com era's fiber optic collapse. In a recent analysis, the private equity giant acknowledged froth in the broader AI ecosystem, pointing out that a single chip maker, NVIDIA, accounts for about 8% of the S&P 500, but says that the core physical assets will still yield compounding returns. It also lists other data points like McKinsey, which has estimated that companies will deploy about $7 trillion into global data center infrastructure capital expenditures by 2030. You might recall we spoke yesterday about $25 billion plus just going into Visakhapatnam in Andhra Pradesh on the east coast of India. KKR has said that this figure, that's the $7 trillion figure, is equivalent to the combined GDP of Japan and Germany. In the US, AI-related capital expenditures are estimated to represent about 5% of US GDP and are currently growing at a high single to low double-digit pace annually, which is a trajectory comparable to the late 1990s and early 2000s tech boom. The four largest hyperscalers, says KKR, that's Amazon, Google, Microsoft, and Meta, are expected to spend more than $350 billion on capex in 2025. That's roughly more than 30% year-on-year increase. So despite all of this, KKR quotes JLL research data showing that North America co-location vacancy shows no signs of overbuilding, at least through 2027. So KKR is basically building its argument on the late 1990s fiber 1.0 build-out, where a roughly $500 billion fiber overbuild led to all kinds of shakeouts. It also says that data centers are fundamentally different due to inherent operational constraints and commercial structures. Unlike fiber, which has low marginal operating costs after installation, data centers are capital intensive to build and expensive to run because of rising power and cooling requirements. And yes, they do pull in a lot of water as well. KKR says that there are also several moats like power, land, grid connections, and permits, which make unconstrained overbuilds impractical. Well, elsewhere, an opinion piece in Bloomberg on how Sam Altman's business buddies are getting stung has pointed out that SoftBank shares have tumbled 40% from late October. Oracle stock has given up all gains made since early September, when it got all of a sudden an AI halo after it announced a $300 billion computing deal with OpenAI. So the three are partners in the $500 billion Stargate AI infrastructure project, which aims to build data centers across the United States. Investors are generally questioning, as you've been hearing on the core report as well, the ChatGPT maker, that's OpenAI's dominance after Alphabet released its newest multi-purpose Gemini 3 model, which won glowing reviews, as well as how a weakened OpenAI may affect its partners' businesses, according to that Bloomberg report. So very broadly, AI is becoming a cash game, and those with the best balance sheets obviously have better odds. But when we talk about balance sheets, Alphabet still has negative net debt despite repeated bond sales, and OpenAI, on the other hand, needs to continually raise venture capital to keep up with its expenses. Well, it's time for feedback on the last day of the core report for the month of November. Remember, we will be back only on the 1st of December, which is also the last month of 2025. Now, the feedback, a lot of it actually comes from one interview that we had the opportunity to do with Dr. Sajid Chenoy, Chief India Economist for JP Morgan. And this is from there. Arvind Narayanan says, so much knowledge, so many new things. Thank you so much, Govindraj. Sampath Kumar says, great podcasts. Sajid seems like a star economist and communicator like Sanjeev Sanyal, Nilkant Mishra. We listen to more of what he has to say in future. Glad he is advising our Prime Minister. Dheeraj Shravan says, can't believe a gem like this is freely available on the internet. And Slamcan 2K says, superb guest, full of insights that are well articulated. Love the show. Thank you. And elsewhere, we also had the opportunity to speak to Manish Garg, who runs a company called InterArch, and they do pre-engineered steel buildings, essentially setting up, for example, warehouses using steel structures as opposed to concrete traditionally. And there are advantages and maybe some disadvantages, but we talked more about the advantages. Also in the context of importing steel and steel prices in general. So the feedback, Shekhar Bharatwaj says, interesting to hear about pre-engineered steel buildings. SP Singh says, heard out on steel versus concrete, great listening. And then there's one feedback which is not specifically linked to this, I think, which is from one thing. And she or he says, there's a part of me which wants this channel to stay small. Excellent content. Thank you. And that's a very touching point, one thing, because that's something that we are also, and we would also and always perhaps grapple with. How do we keep this small and keep it intimate in a way so that we produce great news content that you like and you keep coming back? On that note, thank you very much. It's been a great November, and see you on the 1st of December. Like we said, it's the first day of the last month of 2025. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.